Federal Reserve Bank presidents who run the regional Federal Reserve banks and are crucial advisors to the chairman, Ben Bernanke, tend to be rather conservative economists and businessmen and the like. They are not known for their rebellious spirit, for their dissenting opinions, and for being outspoken in public. But Thomas Hoenig has a bit of all of the above, and I think you'll be very interested to hear what he has to say. He is the president of the Federal Reserve Bank of Kansas City, and he thinks the Federal Reserve is making all the wrong moves as it tries to guide America to recovery. Welcome.
Thank you very much. Delighted to be here.
So the most important thing the Federal Reserve does is set interest rates. And by keeping interest rates very low ever since the financial crisis, essentially it's zero. It has allowed banks, corporations, but also individuals to borrow money cheaply. This has fueled this recovery such as it is. You're saying we need to stop that. We need to raise interest rates. There are a lot of people who look at you and think this is crazy. This is the weakest economy since the Great Depression. The recovery is the weakest since the Second World War. And in this context, to raise interest rates would put the brakes on the recovery such as it is.
Well, I think, first of all, it is important to remember that the policy that was implemented, that we have today, was implemented during the crisis itself. And in that sense, I agreed with that, providing lots of liquidity into the system. But we are well into our second year, almost ending our second year of recovery, and we have to think forward from here. And that is, what is the consequences of an extended period of zero interest rates for future years? And we already see some of the effects, not so much just inflation, but in terms of imbalances in the economy. And I'm not advocating for tight monetary policy, but I do think we have to get off of zero if we want to avoid repeating some of the mistakes of the past with a very easy credit environment.
Is it fair to say that if you look at the charts from the 1980s onwards, what happened is that we have achieved a lot of our growth not by dealing with some of these structural issues, but by encouraging Americans to spend more money.
Correct.
To take out more credit card debt, to take out more housing debt, and that consumption as a share of GDP basically went from about 62, 63% up to 70%. And so we've had a generation of a kind of expansion of credit that was unsustainable because it was not coming as a consequence of an expansion of people's incomes or wages.
Absolutely. We've created a generation of instant gratification because our savings rate, which was running at 8% for years and years, between 8 and 10, fell to 2% or less. And if you look at countries, those who stay great, become great and stay great, they have reasonable savings rate, not necessarily high, but reasonable savings rate, 8 to 10%. They don't consume everything. They save for the future. And their governments don't carry debt that is nearly 100% of their GDP. So we have to step up to that. If we want to be a great nation, and continue to be a great nation, then we do have to address our fiscal challenges. We do have to change the incentives. And a zero interest rate, I'm afraid, encourages consumption. Why would you hold on and save your money when you get 0.02% in the bank? The incentives are to spend. And that's why I say I'm not for high interest rates, but I am for rebalancing, renormalizing policy over a period of time so that you do award thrift. I think it's extremely important we do that.
In terms of what you said, the one pretty strong criticism that you've made is the conditions that allowed all this to happen, the low interest rate conditions in 2003, 2004 that allowed a lot of this to happen. Mm-hmm. Is it fair to say that history will look back on Alan Greenspan very differently and more critically, given the effect, the consequences of his decision, particularly after the bursting of the tech bubble, to keep interest rates very low, which clearly created a housing bubble?
I think that is, I was on the Open Market Committee, so that's something we will all have to think our way through, acknowledge that, at least I acknowledge that I think there were errors. But the real history on that will be years in the judgment, if you will, in terms of all the circumstances.
Well, what's your sense? You've thought about this a lot.
My sense is we erred. We kept the interest rates too low. 1%. It's not that I want to point blame to myself or anyone else, but I do have to say, this is what happened, what were the consequences, and what have I learned from it, and adjust policy the next time going forward. And it is, frankly, one of the reasons that I'm more, if you will, I'll use the word cautious in the sense of saying we need to not have a tight monetary policy, but to begin to let the markets know that we aren't going to assure them of everything anymore.
Thomas Hoenig, pleasure to have you on.
Thank you very much. It's been a pleasure to be here.